Mortgage payments on the average Canadian home rose once again this week. And basically, what we're seeing is hopes of any interest rate cuts being kicked further and further down the road. And meanwhile, a lot of builders, a lot of developers are canceling their projects to bring new product to market. And meanwhile, immigration numbers are hitting yet even new higher and higher record numbers. So this is obviously setting us up for a very interesting fall and 2023, 2024 markets. And so in this episode, we're going to discuss all of those and what is currently happening in the fast moving resale and residential real estate market in Vancouver, and a bit of Canadian notes as well. And of course, we're going to also share our sort of thoughts on where we think all these very important metrics are going to push the housing market in the upcoming months here. So listen, if you're enjoying this, if you're getting any value out of this, please share this with one person who's maybe wondering what the heck is going on with this market and what do they do in it. And even better, if they would like a one-on-one consultation with us, we offer these at no cost. Just click on the Calendly link below and book a time. We're super happy to talk with anybody about real estate and how it's affecting them. So let's get into one of the major factors, of course, that's changing the landscape for real estate, and that's inflation. Because I was out of town last week and there was the inflation print that was touched on, but we'd like to dive maybe a little bit deeper here. Because of course, what happened is it rose to the upside. And while that was actually expected to go higher, well, it beat the estimates, right? It was estimated to hit 3%, rising from 2.8, but it actually hit 3.3%. So why did that happen? Well, of course, there's all sorts of different factors, but the largest one, the biggest contributor right now to the CPI basket is, almost to no surprise, mortgage interest costs, which are up 30% year on year. This is the amount of payments that is going to interest portion of your mortgage, which for some people, it's 100%. 100% of their payment is literally going to just interest. So no surprise that is rising at the rate it is. And of course, contributing to such a large amount of that inflation basket. Now, the Bank of Canada has their next meeting on September the 6th. So that's coming up pretty quick here. We're about 2 weeks away from that. The outcome of that will understandably really affect the fall market, because if they raise, it's going to push sentiment one way. If they hold, it's going to do another thing, and they're not going to cut, but you can imagine what that would do to sentiment. So it's really going to set up a lot of what we can expect for the coming months after that. So on September the 6th, we're going to see a lot more of what to expect within real estate, because it's such a driving factor. And sure, because we're at the rates we are at, even a hold changes the marketplace, like we saw just a couple announcements ago when it suddenly spiked to the upside when it comes to pricing and sales volumes here. The reality is the markets are pricing in right now, are expecting a 90% chance of a interest rate hike at some point in 2023 here, and around a 30% chance of an interest rate hike at that next meeting on September the 6th. So what is going to happen with inflation moving forward for the rest of this year at least? Well, even at a moderate 0.2, 0.3% growth per month, well, that's going to push it up to 4 or 5% by the end of this year. And of course, seeing inflation back in the 4s and even potentially 5s by the end of this year, that is going to change the outlook for many people on, of course, their businesses if they're running them, their houses if they're buying or selling or thinking of doing one or the other. And of course, sentiment overall as far as consumer spending goes. So it's going to dramatically change people's behaviors moving forward, whether it goes up or down. But at this point, it looks like inflation will continue most likely to trend upwards for the remaining part of this year, even if we do see a rate hike next month. So the dream, the hope for many of seeing a lower interest rate or starting to see those cuts happen, it seems to get kicked further and further down the road. There was certainly a part of the year where I thought, and a lot of people thought, that we would see those cuts even by now, by middle of the year, by summer. And then that got pushed down to fall, that got pushed to winter. And now we're talking, well, maybe even mid 2024. The data changes, the outlook changes, understandably. But as of right now, any hopes of a rate cut are basically being priced in a full year away. Mid 2024 is when we can expect them to start dropping as of today, right? And we all know that can change in a month from now. It can certainly change on September 6th, and as further inflation data comes to light here. And then let's kind of objectively look at this. So if, let's say, rates stay where they are until at least another year here, mid 2024, well, most people with that 5-year fixed term mortgage, they're going to be renewing in that time. And if we look back at any time over the last 5 years, the highest rate they would have gotten is somewhere around 1.75 overnight rate, meaning they're probably up in the mid twos, high twos kind of thing. And they're now going to be refinancing with the overnight rate 5.25, somewhere in there, meaning that they're going to be paying in the sixes here, 6% for their mortgage. Quick math here. What does that look like? Well, if you had a $600,000 mortgage when you got it 5 years ago and you're refinancing in the next year, let's say, your payments are going to go from about $2,400 a month to $3,600 a month. That is a 50% increase right there. And that, of course, is a huge sticker shock to many and will affect the spending behaviors of many people and possibly start to force some to consider a sale. Ryan, that was kind of wordy here, but what's your take on it? And maybe we'll get into some bond yields after that.
Yeah, it's funny. I do think that we're going to see higher rates for longer. I do think that we will probably see higher rates, in my humble opinion, probably until this time next year. I don't think rates will come down. And I do think if they do come down, they will come down extremely slowly. I think the Bank of Canada is intimately aware that if they cut rates too quickly, they'll bring a flood of buyers back to the marketplace, and they don't have supply, right? So the biggest issue here is, the whole point of raising interest rates across the entire economy is to kill demand, to allow supply to come back, right? That'll regulate the prices. But what's happened in real estate? Builders and developers went, I can't even afford to build right now. So supply is not going to catch up. And that's the scary part, is we continue to bring in tons and tons of people. Immigration really, I don't think, is the issue. It's how long it takes to build homes. So unless we allow supply to catch up, all we're doing is kicking this problem further down the road and creating a ton of pain in between. So I'm just, the one thing I think we should pay close attention to for next year is that there will be an American election. And in October of 2024, you are going to see the Biden administration doing everything they can to bring rates down and become more affordable. So I suspect leading up to the American election, we're going to start to see rate cuts. There's going to be a ton of pressure there to deliver a more affordable or performance-based economy that works better for the people. With that said, though, we need elevated rates to bring this inflation down. So I don't disagree with it looking like it's going to be at least a year out, but I think come the American election down south, that's when you're going to really start to see things move. Because we know politicians will do just about anything for votes. So pay close attention to that. But what was really interesting last week is bond yields spiked and to the upside by some serious degree. It was a kind of a surprise because they hit 4.15%, which was a 16-year high. This obviously pushed fixed mortgage rates even higher, keeping more and more buyers on the sidelines and more would-be sellers in their homes. When you're going to a big, one of the big six banks for a rate today, you're probably looking somewhere in the 5.6 to the 6% range. 5.6 for 5-year, but if you're, wanting to take advantage of likely what will be a rate cut scenario in 2 to 3 years, then, the vast majority of mortgages are going into that 3-year pool, which is higher than 5.6. As I've said that, though, unaffordability continues to creep higher and higher and higher. Prices, at least here, haven't moved. They've gone up, right? And that's mostly due to the fact, again, because of supply. So when you look at these metrics getting higher and higher and higher, the average monthly mortgage payment on a typical home now has cracked $3,500 a month. We're looking, to be very exact here, $3,535 a month is now the average payment. That's up 15% since the spring, since March. So I think that what we're saying is expect to pay more and hold these rates higher until the economy cools off. at which point I think then it'll start to reset a bit more, and we'll get back into a more typical cycle. But we're not going to be there, in my opinion, for at least another year.
So as you can imagine, what's that going to do to people that are thinking about getting a new mortgage? They're going to wait, because if your buying power is down 35, 40% and the inventory is still low and you don't even like what you can buy with what you can afford, well, you're going to basically be pushed to the sidelines. And this is why we've seen new mortgage applications since at least their recent peak just drop like a stone. But they may have found their floor, because we just saw the data come out for June and new mortgage applications were actually flat month over month. And that's the first time we've seen them go flat instead of down, going back to about early 2021 when things started to cool off. So these new mortgages, yeah, the applications are down like 40% from the highs, which sounds like it might be very, very, very low. But the reality is, you look at the chart, and we're actually just back to where we were from 2017 to 2019. It was a pretty stable time for new applications. And yes, obviously there's more homes and more people since then, so it doesn't quite equal. But again, it's not like it's dropped to multi-decades lows like we're seeing inventory do. The people that are getting mortgages, just like Ryan mentioned, the vast majority are obviously going fixed. Something to the tune of 90 or 95% of people are currently in fixed rates, because I guess they're being more risk adverse. They don't, or they fear they could go higher, but they're also going 2 to 3 year terms as opposed to 5 year terms, because they're feeling out, or maybe they're getting the advice that within that 3 year time frame is when they may be able to then get a new mortgage at a better rate. If you do remember to back in, I guess, the peak of the market, let's call it early 2021, the middle, something like less than half of the borrowers were going fixed. Everyone was going variable because the discounts were so appealing, and you could just buy a very nice home at a very low payment. And so that's what most people were doing. And then again, just for further reference here into what's happening down south in the States here, they're feeling very similar to what's happening here in Canada, right? Obviously, they've got very high mortgage rates and they've got very low inventory. And as a result of that, mortgage applications last month, or I think it was June data as well, came in at almost a 30-year low, the lowest they've been dating back to 1995. For further reference, that's back when the population of the States was like 260 million. There's now 30% more people in the States, and yet they're seeing an almost a 3-decade low in new mortgage applications. So you can imagine that they're feeling a lot of what we feel here. It's a lot of a freeze. It's a lot of just no options to buy. So let's just wait it out, I guess, because you don't have that many other options. If you're buying in the States right now, your 30-year fixed mortgage, which they have, which is amazing that we don't even have the option for up here. As great as that is, yeah, your rate is in the 7s, 7.3, 7.5, somewhere around there. So no wonder that the demand is down like 30% year after year. And also, of course, in the States, they're currently pricing in lower rates by like around March 2024. Also, that gets pushed down the road, right? Look at what we were reporting on 6 months ago, and even in the States, they were expecting much earlier than that. But hey, data changes, the outcome changes. So that's a little bit of what's happening within the mortgage world.
You know, Dan, it's funny. I'm thinking a lot about this, and I feel like when rates first changed about a year ago, I think about 6 months later, everybody was anticipating that now, that was going to be the time when everyone was going to be struggling. I think that has just started. I think really the impacts of the decision making to raise rates at the crazy pace that they did, we're just starting now to really see these effects. And it's going to be a very telling time to whether or not they've overcorrected or not. And I just you got to think, if you're qualifying at 7.3%, and that's average, right? There's going to be some markets where it's 8-9%, right? That doesn't buy you much home. So I think, if that continues and people continue to restrain spending, it could cause a much quicker snap back the other way too. It'll really depend on the sentiment and how people react to these things. But I actually think that this sounds crazy, but I still think the Fed down south is going to raise again. I don't think they're done. And until they have a clear line of sight that inflation is hitting that 2% target, I know they talk about 2 to 3%, Dan, but let's be honest, it's 2% that they're chasing. And until you get there, I think that they're going to, blow down the door until they get there. I just, and it's going to be at some cost. There's people that are going to get hurt. And I think we're right on that. Just to talk a little bit about population, because population seems to be becoming more and more of a pressing topic for people when it comes to buying a home, when it comes to the economy. And maybe rightly so, but population numbers have been breaking records for the last couple of years. And, Q2 of 2023 is no different. International student admissions are up 21% year over year, up 34% for Q2. This is crazy. Temporary workers are up 45% in June and 71% for Q2. So to give you some idea in terms of numbers, in 2019, that equaled about 350,000 people. Temporary workers hit 900,000 in the last 12 months. And so we're seeing more and more debate about, is immigration the problem or is housing the problem? And honestly, it's a bit of both, but realistically, we've had 30, 40 years to continue to build more and more homes at a faster and faster pace. Just not done that. And, on the flip side, immigration has continued to grow. Canada is a vast country, but the vast majority of people end up in the urbanized centers, which is where a lot of this pain stems from. So we need more homes. Maybe Dan talk about some housing starts here, because that's what we need.
Yeah, definitely. I just want to add a little bit to that, because looking at that number of 900,000 temporary workers in just the last 12 months, keep in mind, they don't come to Canada and go, cool, I'm ready to work. They're entering with a work visa. They already have a job lined up. So to think that there's that many jobs that are still, I guess, vacant, available for people. I remember once we reported, I think it cracked 1.1 million job openings. And so here we go. These are being filled by a lot of temporary workers, and people go where jobs flow. And here's just further data that exemplifies that. But yeah, where is everybody living is still the question. And of course, temporary workers, the vast majority are renters. So understandably, rental rates hit an all-time high, like we discussed just last month. And guess what? I can only imagine that once the August data comes out, will be a broken record once again. And my guess is that August rental rates will be a new all-time high across Canada as well. But yeah, housing starts. So as the population grows, people need to live somewhere. So we need to have homes built. And housing starts are currently still at 15-year lows, not adjusted for population growth. And it doesn't take too much of a Google search or opening up a newspaper to find articles that are mentioning that somewhere around the amount of 22% of Canadian home builders are canceling their projects right now. And why would they do that? Well, of course, because the numbers don't work out, right? They don't pencil. They're not going to make money if they go to market with these, for a couple of reasons. One, the cost to build is so high. And of course, two, the cost to buy on the other side is so high that a lot of people just can't afford to buy them. So they're on the sidelines, hence the overall drop in sales volumes right now. So when demand is down, even though demand is high, but the suppression of buying power is down, builders just don't have any incentive to come to market. If they know that they can't hit their sales targets, or they know they can't even just sell to a degree that they can make the money or come to market at an attractive price so that they can actually make those margins, they're not going to. And so 22% is now. And of course, the longer that these rates stay elevated, the higher that number will likely become. And the further the housing starts will pull back. And this is, of course, happening at a time when housing is already at critical levels when it comes to inventory, and housing starts are one of the most important things that are needed right now. And yet we're seeing that trend the exact wrong way. So what about the homes that are under construction? Yes, great. Those are sitting at around record high levels. Do remember, 50% of the properties under construction are rentals. Yes, also needed. But if we're going to focus on more of what we do here with the sale of real estate, well, when the vast majority of what's under construction is going to the rental market, it's not going to help the supply for end users here. And of course, once all of these projects that are under construction complete, well, you're going to see these current record high number of under construction properties drop way off, because of course the housing starts is what happens first before you see the under construction numbers. So expect unfortunate news here, in the sense that housing inventory is looking to remain tight for the foreseeable future as developers are pulling back on new projects.
I mean, it's very much what we talked about at the start, right? Like, if you raise rates to allow supply to come back, you kill demand. But if you can't help the people who bring the supply to the market actually bring that supply, this is just a cycle that we're in, and it's just going to repeat itself further down the road. There's, the Liberal government came out and said that they were going to build 4 million homes in some record time period. I don't think they've started a house yet. At least I haven't heard of a major project announcement. I haven't seen any massive buildings, the federal buildings, getting retrofitted for condos. I just don't see it happening. And there's not enough action in this area of our economy, especially on the supply side, to make a notable difference for the foreseeable future. It's kind of scary in that respect. With that said, let's talk a little bit about the nasty R word, recession, because honestly speaking, I think we're actually in one. I mean, a lot of this is going to depend largely on the employment numbers. And I think rate hikes will also depend largely on where employment figures come in. So let's take a look at some of this. So unemployment rate in the last 3 months, at least in Canada, has been up 0.5%. This amount historically indicates that we are either in a recession or headed towards one. But get some of these stats too. So employment insurance claims jumped 16% month over month in June. That's a huge number. Retail insolvencies also jumped to a multi-decade high in Q2, sitting at almost double the long-term average. Credit card lending jumped again, up 0.6% in June. It's up 13% year over year. This is a big indicator that people are struggling to pay. They don't have the money to pay for the lifestyle or the things they actually need in their life. So they're leaning on more and more credit to get by. This, I don't think, is also a Canadian problem. This is going around the world, right? This is also seen in consumer insolvencies, which has jumped 20% year over year in June, and led by a 37% increase here in BC alone. Do note, though, this metric is still lower than back in 2019, but we should be paying attention to how quickly it's rising. Business insolvencies jumped 23% year over year, but the dollar volume rose 481% year over year. That's a staggering number. All of this has yet to hit the mortgage space. So with mortgage delinquency rates remaining at rock bottom lows, over 0.15% nationally. So a very, very small number. But look to this metric. It will rise over the year, though likely not enough to see any kind of foreclosure inventory that will allow for price changing to take place. I don't think we're going to get enough supply out of that to change the marketplace. So again, I think when we look across, and you got to think, like, we've got we've got a bunch of natural disasters taking place right now in BC with wildfires. And there's going to be significant economic hard times in the province just to rebuild some of this, to get people back on their feet. It's going to be a tricky couple of years here. And I think a recession, we are just on the tipping point of here. Dan, what do you think?
Yeah, there's clearly an immense amount of financial stressors right there, and they're building, right? You can feel it, you can see it, and of course the data shows it. And yet, quite typically, we see it stress the housing market last, because people need that roof over their head. And as I always mention, if you can't pay your mortgage, well, you're out on the street and you're paying record high rent. So people tend to find and do whatever it takes to pay that mortgage to keep that house. And ultimately, moving forward right now, it's just we're entering almost another deep freeze, right? We've got this like 20-year low in national inventory. We've got people that are stressed with their finances, but they're keeping their home. They certainly can't afford to really move up right now because, of course, it's so hard to qualify. And new buyers, they're qualifying, but in the nines right now, in the high eights. So it's hard to do anything in housing, and the new builders are pulling back. So it's going to keep everything just kind of frozen. And maybe move a bit sideways, right? We've seen prices up 8% this year, which is fascinating and makes no sense. But that'll probably go flat for a while here. People are going to stress out, and then let's also remember too, this thing, if and when these interest rates do come down, well, we know in talking to our lending professionals that there's just a backlog of buyers that are ready to go, but they can't do it until they can do it. But again, every single time we see sales volumes drop, we know the pent-up demand exists. It's just cyclical history. It happens every single time. And so that's also pending as well. But of course, when they come back to market, let's say when sentiment changes, well, guess what? There's so little to buy. It's going to do that same thing it does to pricing every single time. So that's kind of some thoughts for this week. Next week, the August numbers won't be out quite yet as far as the official numbers go, but we'll share everything that we can with you and give you some early indications of what did happen this month. And I think too, maybe Ryan, next week we talk a little bit about what to expect for the fall market, because it's going to be unique. And like we just mentioned, a lot of it may hinge on the September announcement from the Bank of Canada. And also we'll touch on too about, who's actually going to be bringing product to market, because, at the end of the day, if people can't afford or doesn't make sense for them to move, well, homeowners aren't going to be bringing product to market. So we'll have a little chat here about developers and the ones that are bringing product to market, and kind of how you can benefit from that.
Awesome, guys. Well, thank you so much for listening this week, and probably a great place to wrap it, Dan. And I'm looking forward to next week's discussion. I want to know where the homes are coming from. So stay tuned for that, and we'll catch you next week.